So the next topic that we are going to learn is a very interesting topic as well. That is called as money laundering. So what is money laundering? Money laundering, as the word says, is where you launder the money. Now, money is your cash flow, and you get cash flow through legitimate sources. Then it's easy for you to spend because the government is not gonna penalize you, or they are not gonna scrutinize you, because it's your money that you earned in the legitimate way. What if you get the money in an illegal way using certain criminal activities, drug dealing, selling illegal items, selling uh, selling for example guns, arms and ammunitions, selling drugs, or in fact doing some black money kind of an activity. So how do you spend that money? Because the moment you spend it, let's say you get a illegal money through drug dealing, and I spend it and buy a car, they're going to ask for source of funds, because the bank is going to ask for source of funds, because the person who's going to give you the car will need your bank details, etc. And they'll ask you what you do, etc. So you cannot buy things, or you cannot spend it wisely. But somehow you will make the money which you have received it in an illegal source, like in how we put clothes in a washing machine in our laundry, where it cleans it up and comes out as a clean money. Similarly, what you will do for even the illegal money is you put it in the system and it comes out as clean. Somehow you will entering into the system and it comes out clean and as a legitimate source. That is called as money laundering. So money laundering is ultimately the process by which criminal attempts to conceal the true origin of ownerships of the proceeds from a criminal activity. I can give you a very good example. I don't know if you have seen a series that is called as Narcos. There was a big time drug dealer called as Pablo Escobar. He was in Colombia. He used to do drug dealings like cocaine. He used to sell cocaines and export them to US, and he used to get millions and billions of dollars in cash. And how he used to conceal the money and say that okay, he's a rich guy through legitimate source is that he said he's an owner of a taxi business, and all the proceedings are from his taxi business, or all his revenues are from taxi business. He went and bought, by paying cash, a lot of real estates, a lot of luxury goods, and that's how he converted into the illegal money into white money for some time. But ultimately he got caught. But yeah, so money laundering is the process where you try to get the dirty money clean. And to get the dirty money clean, the criminals use 3 stages. They use it in 3 stages. The stage 1 is placement, stage 2 is layering, and stage 3 is integration. Stage 1 placement is where you place somehow the illegal money into the financial system. Like ultimately, all the illegal cash that you generate, let's say for example, I have a truck, I created a truck, I sold it to someone, and he will be giving me cash. He's not gonna give me bank transfer, because if I get bank transfer, somehow I will have to give the source of that money to the bank, right? Bank will ask, let's say for example, I get $1 million. Bank will ask, how the hell did you get $1 million? There was hardly $10 for the past 6 months in your bank account. How did you get this $1 million? So they're going to ask for the source of money. So, but what we do is, whatever the cash we get, on a small cash we get, we place it somehow into the financial system. We enter it into financial system. For that, what do? They chunk it. They divide it into smaller chunks. And they place it through having certain businesses which are cash intensive business. For example, retail businesses. For example, buying maybe some kind of luxury goods, having like businesses which are more cash intensive or cash sensitive businesses, like for example taxi business, as I tell. Restaurants, there is in fact a case where the politicians, a lot of political parties, specifically in India, to ensure that they somehow make the black money white, they get the money, they go for a certain kind of tour or government related tours, and spend huge cash related money into the restaurants, and they get fake bills and claim it as if they have spent the money, and somehow the cash the restaurants they go to is actually owned by them itself. So the politicians, that's how they conceal the money. Like they own restaurants. So restaurants is a very good way to convert the illegal money into cash. Because why? Because ultimately, if you go and spend in a restaurant $100, you will be, paying by cash. Like if you go to a good restaurant, you might be paying more than in India, 2,000, 3,000 rupees. You might be paying in cash. You might even pay 5,000 in cash. You go to a good 5-star hotel, stay there for 1 night or 2 nights. You might spend 20,000, 30,000. You pay by cash. So cash related items, when they accept into those businesses, they buy these cash related items and they pay money and get all the get converted the illegal money into white. So that's how they place into the financial system the illegal money. Somehow they make it into the financial system, where they take the large chunk of money, large sum, they break down into parts and enter into the financial system. So once somehow the illegal source of money have been brought into the financial institution through these cash businesses or through restaurants, then to ensure that they don't get caught, the criminals do something called as layering. Like if you, let's say for example, if you take your bookshelf itself, you keep a book and you keep lot of layers of book on top of it. It's very difficult for you to identify one specific book, right? Like let's say you keep your white part of the book here and then you keep like all of them on top of it. It's very difficult for you to identify one specific book. That's why books have all, name of the book written on the side of it, like on the printing edge part of the book, the other part. So when it comes to layering, once the financial institutions have accepted the illegal source of money, how somehow it has been entered into the financial institutions, then multiple routes of transactions are created. Multiple transactions or multiple routes of transactions are created. Like there will be a company. A company will be actually the one who's doing the illegal source. They will send it to their parent company in B company, which might be situated in, let's say, abroad. From abroad, they will show it as if the B company gave a loan to C company. And they'll show it as if C company bought a car from D company, and then D company ultimately owes to the A company. Somehow like that, they will bring it into the system. So what they will do is A company actually is having the restaurant business. The illegal source went into the A company. The illegal cash went into A company. Now this from the A company, they will source it to B company, which is a parent company. The B company will then give it to C company, then C company will give to D company, and then D company will go to A company. That is called as layering. So when this kind of transactions happen, there will be multiple transactions that they will be doing on a simultaneous and a continuous basis, which will make it impossible for the regulators to identify that actually A company is doing money laundering. That is called as layering. The third is, it started with here, okay, it started with A company. It went a circle, came back to A. The money came back to A company. Now, this have to be somehow converted into physical assets. So for that, what will A company will do? A company will buy assets, costly assets. A company will buy costly assets like real estate, luxury cars, paintings, etc. That is called as integration. So just to understand this in a much simpler way, let's try to look at an example. Let us say there is someone called as Pablo, okay? Pablo, who is a drug dealer. Okay, this guy is a big red flag. So he is a drug dealer. And he earns millions of dollars through cash. Like let's say he earns $1 million on a yearly basis. Now what Pablo will do? The Pablo, he will establish a business called as P company, which is basically a restaurant. Now, and what he will do to make it more easier for people to ensure that okay, he's getting the $1 million through his own restaurant. What he will do is he will ask all his employees. He'll give this $1 million in cash to these employees. Let's say he will give each one of them $10,000. Okay, and then And then he goes to the restaurant. Okay, each employees will go to the restaurant. They will show as if they have spent, each one of them have spent $10,000 over a period of time. Let's say in 6 months, they would have spent this $10,000. For that, the restaurant, what they will issue? They will issue bills. They will give bills to the employees. Now, this becomes legitimate. Now, with this bills and with this customer information, this P company, what they will do? They will deposit all this money daily into the bank. They will deposit this money daily into the bank. By taking all these bills and all this cash, they will deposit into the bank. Now again, there is a risk. Does really this company is having $1 million on a revenue basis? What they will do to ensure that they don't get caught? What they will do? They will do, start doing a lot of laundering. So this particular situation or this particular process, this is called as placement. Now this exactly is called as placement. Now this P company, what they will do to ensure that they don't get caught, they will do something that is called as layering. Now for layering, P company will take this, let's say for P company, they need let's say a good equipment, a kitchen equipment. And what they will do, they will show that, okay, they made the kitchen equipment, they bought it from Z company. They will show a transaction as, okay, they bought this kitchen equipment, Z company, for $5 million. And they gave $5 million to Z company. And then Z company, what they will do, they'll say, oh, this Z company's owner is Y company, which is situated in, let's say, Bahamas. And so they send the dividends to Bahamas. And then Y company have a subsidiary, let's say in India. So they gave loan to the subsidiary in India. The subsidiary, in fact, will come back. Ultimately, the subsidiary, in fact, somehow will come back to P company, stating that, okay, they want to do business, so they will do an investment in P company. So the $5 million which P company gave to Z company will come back. So the $5 million which P company gave to Z company comes back to Y company, went to the subsidiary in India, and ultimately as investment is coming back to P company. That is how the second part of the laundering happens, where huge chunk of money are layered into the multiple streams of transaction. So P company, they have started a restaurant business. They have earned $1 million. What they will do? They'll say, oh, you know what? One of our owners, $5 million he has earned. He has gone and bought a Z company and equipment. Z company, by way of dividend, have given to the owner in Bahamas. Bahamas, in India, they have another subsidiary. They gave a loan to the subsidiary in India. The subsidiary in India is actually, investing in this P company as an investor. So now it's a circular motion. This entire process is called as layering. This entire process is called as layering. And finally, once P company have got all this money with them from the illegal sources which have been converted into white, then P company will do something that is called as integration, where they will buy, okay, luxury products, luxury goods. Like they will buy new real estate, or a new posh building in one of the good prime locations. They'll buy cars in the name of the company. They'll buy paintings, luxury paintings. They'll say, okay, we have bought a luxury painting which is worth $1 million, $2 million, and we have put it on the wall of the restaurant. And trust me, guys, this is exactly happening. As you can see, like a lot of restaurants which have been opened up, even though there are not even one single person, think next time that it could be due to a laundering business. This is how exactly the illegal source of money are with a practical example, gets converted into a legitimate source. This is the exact way. Now, since that you know what is now money laundering, let us now understand what are the offenses in relation to money laundering. There is something that is called as Financial Action Task Force, the FATF, which was established in the year 1989, has clearly been established as an action task force by the government to ensure that such money laundering instances does not occur, or to counter against the money laundering instances. And the FATF has clarified a number of criminal offenses which are relating to money laundering. And many of these criminal offenses have significant impact on the auditor, and it's therefore imperative that the firms are aware and consider the risk that they may be committing as on an offense. So money laundering is considered as a criminal activity. So auditor who are either supporting money laundering businesses or who are aware of money laundering businesses and still not reporting, like their client is a money launderer and still they are not reporting about them, or giving a tip to the client and saying that, okay, you know what, you are being suspicion for money laundering. The government had called us and investigated about you, so ensure you play safe. That's tip off to the client. So if you do a tip off, you are considered, the auditor will be penalized, as well as they can face criminal charges, arrest, your profession can be debarred, etc. So as per the FATF, the key offenses which significantly impact the auditor are: number 1, acquiring, using, possessing or concealing criminal property. This is where you are actively involved with the company which are doing money laundering activities. You're making them arrangement, you're helping them with their accounting, you're helping them with their auditing, you're helping them conceal their illegal source of funds, etc. You are directly involved. You will be considered as a direct involvement to the money laundering activity. Second is, that you are aware, or you are having a suspicion, or you are aware of the knowledge that a company is doing money laundering activity, but you fail to report to them. You fail to report to the government. So even if you suspicion, so let's say for example you are an auditor, you are auditing a client and you are suspecting that they are doing some money laundering businesses or they are doing some money laundering activities, you are required to file a report to the National Crime Agency, NCA. In UK, NCA receives around 300,000 suspicious activity reports over each year. So there's nothing harm as an auditor. If you feel that, okay, you know what, these are money laundering businesses, you can raise a report and protect yourself. If you don't, and if you found out that, okay, you know what, you had the knowledge, and if the FATF finds out that you are having a knowledge of this and you didn't fail to report it, you will be considered as a criminal offense as well. The third one is much more serious. This is tipping off, where the client is considered to be suspicious for money laundering, and the government started investigating them, and you came to know that the government is investigating your client, and you helped the client. You tipped off to the client. That is called as tip off. You're giving a tip to the client that, hey, you are being scrutinized or you're being watched, be careful. That is also considered as a serious offense, and criminal charges can be raised against the auditor for giving a tip off to the client that they are under the suspicion, or giving information to the client regarding the money laundering investigations that could be done by the government. Now, there are international efforts to combat money laundering. Very recently, I don't know if you read the news, in Singapore, more than $1 billion was seized in money laundering cases. Around 30 member, and it was spread across 10 to 11 core members. A 30-member gang was actually arrested. Middle-aged, more than 35, 40-ish people, 40-aged people were arrested for money laundering. Like huge luxury goods, bags, paintings, gold bars, comprising around more than $1 billion were actually seized as part of the money laundering cases. There have been instances where companies themselves do money laundering, like for example BCCI, as I told you, they do terrorist funding, etc. Very recently, due to technology related items like bitcoins, where bitcoins are and cryptocurrencies are being used for illegal money laundering uh, practices. Like what they do is they take up the illegal source and they convert it into bitcoins and store them. And that bitcoin, they create a bitcoin company or they create a bitcoin shell and they convert it into bitcoins and cryptocurrencies and store them. And the bitcoins are used to actually fund the terrorist organizations, as well as what we have heard. So internationally, this money laundering is a bigger issue. It's not just impacting one specific country. Multiple countries are getting impacted. Companies which are becoming more richer day by day, they try to conceal the money by doing international transactions. That becomes a pain in the ass for the international countries as well. So there is international efforts to conceal and combat the efforts of money laundering cases. And what ACCA gives is that ACCA gives specific guidance to the members, like to future members like you who are AAA students. It's very important that you know the guidance right away. You should know what ACCA talks about when it comes to the money laundering activities. Now, the key elements of the guidance talks about firstly is internal control and policies. Every members should ensure that their staff receive regular training and to ensure that there is client identification processes are carried out correctly and that knowledge of suspicions of money laundering or terrorist financing are reported. So, to give you a very simple example, I was working for a company called as JP Morgan. In JP Morgan, or be it in Goldman Sachs, or be it in EY, there are specific training programs that are being conducted, or we have webinars or seminars that are being conducted which talks about money laundering. They give us classes or specific training programs, and in fact you are more related to a specific department, like let's say transactions department with the clients, or you're dealing with quite a lot of clients, then you are given more trainings with respect to money laundering. So as the moment you become an ACCA member, it's very important that all your staff, like you, if you are going to practice as an auditor, all your staff are aware of money laundering and proper trainings are given to them to know what money laundering is all about, what are the various processes in money laundering as well. Like I was working in EY. EY is an audit firm, and in audit firm, they have to give trainings, proper trainings, and give detailed trainings and learnings about money laundering and what are the money laundering processes, and we are required to do regular compliance training in relation to money laundering as well. Every firm is required to set up something called as MLRO. In UK, it can also be called as Money Laundering Compliance Principle, or MLCP. So every company or every firm have to have a money laundering reporting officer, where if there are any kind of money laundering suspicions is reported, you have to report to the money laundering MLRO within the firm, and the MLRO will ultimately report to the government agencies or government authorities. In UK, role can also be fulfilled by a separate officer known as MLCP, Money Laundering Compliance Principle. Although one person can fulfill both roles, if sufficiently senior within the firm. So money laundering reporting officer is where you take reports. The money laundering reporting officer, all he takes is the reports from the various people out there in the organization, and if they have got any suspicions from a specific client, you have to report to the MLRO. And MLCP is much more senior. Compliance principle is much more senior. He needs to ensure that the firm is properly compliant with money laundering activities. What that means is the firm is having enough compliance related matters where there is all the staff are being trained, the proper reporting channels are being established, proper process is established to ensure that money laundering cases are being identified, to discourage from people from accepting money laundering related clients, etc. There will be called as a money laundering compliance principle, who takes care of the compliance matters the firm has to fulfill in terms of money laundering cases. So in UK, the role of the MLRO can be done by the MLCP itself, the principal himself, who's supposed to be senior, and all the reports, the firm which it identifies, if there are any suspicious, it can be actually diversified and it can be reported directly to the MLROs. So the MLROs will be internal within the firm, and it will be a single person or it will be a team of people where all the people, staff members or all the employees of the firm spread across, doing audits of the client. If they identify a suspicion with a client, they can report it to this internal person who is a MLRO in the company or in the firm, and that MLRO will report it ultimately to the government authorities. The reason why they are doing this is because, let's say for example, in a firm there are 30 to 40 staff. Now within one firm itself, they have to report it equally to the government. Now if 30 to 40 people start reporting separately to the government, it becomes so much of chaos, and ultimately the firm needs to know all the details. Like, they cannot report, any staff member cannot directly go and report to the government. The firm themselves needs to know whether they are dealing with clients relating to money laundering activities. Also, the firms are required to have strict procedures called as AML procedures, that is anti-money laundering procedures and policies. The firms needs to prepare their own internal document in relation to the procedures they are going to follow with respect to anti-money laundering, counterfeiting activities that they have identified. Even certain companies like banks, financial institutions, for example, are required to have, as per the regulation and as per the central bank of any country, to have strict AML policies. When I used to work for a bank or when I used to audit for a bank, we used to review the anti-money laundering policies and procedures of the bank. When I was conducting an audit for a big bank in Saudi, one of the procedure we used to ask in terms of internal control is definitely the anti-money laundering procedures that the bank used to follow, and what are the procedures they used to enhance. Sorry, they have enabled to ensure that the clients of those banks or the customers of those banks are falling under this money laundering activity or not. So the banks have their own procedures to identifying these money laundering activities, and we used to ask those anti-money laundering procedures of the client and use it as part of our internal control testing. So we used to test it where one of the procedures will be taken and checked whether the money laundering provisional act have been implemented or not by the client very clearly. So it's not just the auditors who are required to have anti-money laundering procedures. We do have, for every firm should have an anti-AML policies and procedures, but at the same time, certain kind of regulatory companies, highly regulated companies in the form of financial institutions, banks, etc., also need to have anti-money laundering policies and procedures that is required very clearly by the central bank of the country or the regulatory board of that particular country. So that is called as internal controls and policies, where the firms will establish an MLRO officer and all the employees will report money laundering activities to the MLRO, and thereby they report it to the necessary government agencies. That's the first step they have to do. Even before you accept a client, know your client very well. It's called as client identification. Do your customer due diligence and have a proper know your client processes. Get details about the client, get identifications, know about their cash flow, know about their businesses, know about their accept the client only after taking all the documentation, what kind of business they do, who are the owners, who are the board of directors. All of those things have to be very clear and very precise, and it's very important that you know your customer even before you go ahead and accept a client and start the audit process. Record keeping. All the members should ensure that they retain all client identification process at least for 5 years. All the records relating to the client, the relationship, the financial statements, all the transaction, all the work that have been carried out have to be retained at least for 5 years. Because money laundering is a serious and very difficult process to identify. As I told you, if P company, the Pablo's company, is having a restaurant and they are doing a lot of layering in process, it becomes very difficult to come out and identify a company which is actually doing money laundering. If it was easy, then thousands of companies would be actually identified as money launderers. It's not easy. There are millions and millions of companies. To identify one company as doing a money laundering company is not easy. So hence, at least 5 years, at least for a period of 5 years, this companies, companies' records have to be retained, so that even if it takes 3 to 4 years for the investigation to happen and complete, the records are appropriate with the firm and kept intact with the firm. Recognition of suspicion. Suspicion can be described more than speculation, but falling short of proof based on the firm evidence. So suspicion is not speculation. Speculation means you have a very vague doubt. You're thinking out loud. You're just doing a judgmental decision. Okay, you see someone having a good coming with a good suit, and he's getting off a car, and you think that, oh, you know what, this guy is a fraud. That is speculation. Like, you don't have anything to prove. You're just being judgmental. Suspicions is where, you know what, last month he came in auto rickshaw and he came in cycle and he used to wear shabby clothes. This month suddenly he's coming in BMW. That is proper suspicion, because this transition did not happen in a less than, let's say, 5 years, 6 years. It happened in less than 1 month. That is proper suspicion. The same guy, right? But just because he's coming in a BMW or he's wearing a suit, etc., doesn't mean that we have evidence. We need proper evidence saying that this guy has done, money laundering activities. What if he won a lottery? This guy was, he was in rags and he became rich by way of lottery. What happens? Right? So just because a guy became famous or he became rich doesn't mean that he is actually doing a money laundering business. So you need to have proper evidence for that. But even if you're suspicion, you can report the suspicion. That's what the government says. Why the government is asking to report even the suspicion? Because any kind of tip that the government receives will help them to start the investigation processes. Right? So special attention should be paid to any transaction without any visible, lawful or economic purposes. So I'll give you an example of this suspicion as well. Like, I had a bank account and there was not much of funds in that bank account. All right, it was like a plain bank account. I did not invest any money in that, and it was kept for us as an idle for a long period of time. Suddenly, I started using it, and so some preliminary source of funds. It's not like in crores or anything, but some heavier amount started coming into the bank account. More than, let's say, a lakh, and lesser than, let's say, a 6-digit number. So started coming into the bank account. Suddenly I got a call, and the bank started asking me question like, how did you get it, and what is the source of this fund? So I had to give them the source. So see, that's a suspicion. So banks are required by the regulators to function in that way, that if they see, okay, some kind of a bank account which has been idle for some time and suddenly funds started moving into the bank, you question the person, the holder of the account. You start questioning him, like, why you are getting so much money. That's suspicion. And if the bank starts seeing that this guy is getting money but he doesn't have a proper source, then definitely they will report it to the government. And they will start investigating me, like, how am I getting these source of funds? So firstly is to identify the recognition of suspicion. Like, you need to get to know whether a transaction is a suspicious transaction by looking into the transaction. Like one, where it could be transactions could be 1 rupee short of $1 million, 99999. That could be a suspicious transaction, because $1 million is requires certain regulation. Less than 1 million, you don't need to do. So $1 short, $100 short, or same bank account multiple times you are getting this money. That's a suspicion. The client is getting from same bank account multiple times. Small amounts, but multiple times. Added together, it became a huge amount. Those are all suspicious. Reporting suspicious transactions. So if you're identifying certain suspicious transaction, you can report to whom? The MLRO. if the company, the MLRO of that company. Tipping off. You should never tip off. So if you find out that this is suspicious, don't go to the client and tell them that, see, you are doing something wrong. This is a suspicious to money laundering. That is tipping off. Because you are giving client a tip that, see, this transaction could be emerging as a money laundering offense because it seems to be suspicious. So if you find certain transactions of the client to be suspicious, don't tip off the client. Keep it with you. Keep it with you. You give the report to the MLRO and the MLRO take the necessary steps. The MLRO should take the necessary steps. However, attempts to discourage a client from breaking the law will not be seen as tip off. So if you are an auditor and you are seeing a client and client is trying to do some money laundering where you have seen a few instances, one or two instances where they are doing some illegal activity, trying to do some illegal activity, then you can say that, this is discouraged. Like I think this is not right. This seems to be like money laundering. We don't want to involve in this. That is discouraging. You are allowed to do discourage, but don't tip off to the client saying that, okay, we have reported this to money laundering. Now you will be under suspicion or you will be under radar. Don't do all those things. Or don't show the necessary transactions to the client and go to them and tell them that these looks like a money laundering. Please be careful. Those are all clear tip off. You're giving client ideas how to prevent money laundering flags and help them to do money laundering. So that's considered as a tip off. So these are the guidance that is given by the ACCA. As members, we should follow specifically when we are auditing a client and to ensure that we identify report money laundering activities. Now, the guidance on members' responsibilities mentions the requirement to gather the KYC information. So we said that one of the guidance of ACCA with respect to money laundering is to do a customer due diligence process or a know your client process very well. Now the ACCA also says what specifically should form part of the know your customer process or your CDD process. Like we need to know who the client is, who controls it, like who are the individuals who controlling it, who are the shareholders. If it is a company who's a shareholder, which company is that, whether that company is audited by someone, where the company which has invested, whether it is in a tax haven like Bahamas, Bermudas, Mauritius, etc., or is it situated in some other foreign country? Is it a local which is a local company, or is it a foreign company? All of those things, who controls it, who are the individuals, who are the shareholders, their documents, their details relating to the shareholders, their ID proofs, all of those things we need to have. The purpose and nature of the business relationship, like what are the relationship they do, what all relationships do they have in the business, what are the nature of their business, what kind of business they are involved in. Is it cash related business? Then definitely there is a risk. If they are doing financial institutions, more risk in relation to money laundering. Specific procedures we have to do to identify money laundering issues in financial institutions. Are they, fintech related companies? We need to have more risk in terms of the money laundering. Nature of the client, what are their, what is the specific nature they are doing the industry? Which industry are they part of? How do they get their investments? Who funds them? What are their source of funds? What are their source of revenue? What are the source of customers? What kind of expenses they have? Which business relationships they have with various folks out there, etc. The client's business and economic purpose, like why do they have this business? What is the intention behind having this business? The reason why is because, let's say for example, there could be a company which has been specifically created for money laundering. They are loss making, but still shareholders will not close them. They'll keep it. That itself is a suspicion. Any shareholder who having a loss making company will never, keep the company open. They'll try to close it as early as possible. But if you are having a company which is loss making and you're still opening it, it's a suspicion. So, in UK, the money laundering regulation extends the circumstances under which the customer due diligence must be carried out for the new to existing clients. So UK specifically says that customer due diligence process have to be carried out for new to existing clients. Now the CDD term, the customer due diligence in money laundering, says specific procedures that auditor have to do with respect to the clients, like client identification. We need to get the documents related to the client, like proof of incorporation, government related documents like any tax related documents, or partnership forms, then partnership agreements, incorporation certificate, if it is for individuals, their passports or identification certificates, their share certificates, etc. If there is any beneficial owner who is not the customer, then this is the individual behind the customer who ultimately controls the customer or on behalf of the transaction or activity being conducted. So we need to have know the details of the beneficial owner, and all of the details, like who benefits from the company and who establishes or brings a lot of customers. We need to know about them as well. If there are any business relationships being established, we need to know what is the nature of the relationship between those people, with the company and the customer, or maybe the supplier, what kind of relationship they have, what are the transactions they do, where the source of funds are coming from, what kind of business we do, the client does business with, which kinds of customers we do business with, have the client knows their customer to whom they are selling their products, etc. All those things we need to identify. So it's very important because to do customer due diligence or KYC in money laundering, because the first level of suspicion happens by knowing your client. By just, doing certain kind of procedure, you will come to know whether the client is actually doing money laundering, because they might not be having clear purpose. They might be loss making and still they're running the business, or they might be having a lot of huge financial transactions. All are suspicious for money laundering purposes. So as an auditor, I told you in the last class is that we take a risk-based approach. Like we look at the risk, and if there is a risk, we kind of mention the responses or the actions we need to take to tackle or mitigate the risk. So on any assignment, the auditor should have the risk of money laundering activities. Clearly, every circumstance is different, but the following diagram actually illustrates what is the process we need to follow when it comes to the risk-based audit. These are the risk indicators in relation to money laundering. Like if a client is doing large currency bearer or instrument related transactions, like they are doing large currency dealing transactions, they're doing a lot of foreign currency dealings, this suspicious, that's a risk of money laundering. They have excessive wire transfers. They are a restaurant in India, let's say in Goa, they're established in Goa, and they do quite frequent wire transfers to, let's say, certain tax havens in Mauritius. Why are they doing that? They are just a simple restaurant in Goa. Why do they have to do transactions with a Mauritius company? That's a suspicion. A pattern that after a deposit, the same amount is wired to another financial institution. That is also money laundering. Like you receive deposits from someone and immediately you transfer it to another company. So let's say, for example, A is a financial institution. The moment they receive deposit, it's immediately wired out. A gets money from X, it's immediately wired out or it's sent out to, let's say, a company called Y. Like, why are they doing that? That is layering. Why? Because they're getting the transaction, immediately they're transferring it. That they are trying to do it through layers. The transactions increases immediately. Repeated deposits or withdrawals just below the monitoring threshold on the same day. Like in India, there is a rule that any transaction which is above 50,000, cash transaction above 50,000, we have to get the PAN details of the customer. So if you go to an electronic store, let's say you go to Lulu Mall, you buy an electronic item and you're paying more than $50,000 in cash. You have to give the bank details. So what do you do to Lulu? You'll buy a product which is only in 49,999. You do that 10 to 20 times. Money laundering. So you either have a transaction or you have a deposit which just below, as I told you, just below the monitoring threshold. You cannot, definitely, regulators cannot investigate all the transactions. So they keep a threshold. Now that threshold, just below the threshold, you do a lot of transactions. That becomes a money laundering risk. High value deposits or withdrawals not characteristics of the type of the account. Like as I told you, I had a bank account which was kept idle. And suddenly certain funds came in and bank called me and started asking me questions. So I had to give them source of funds. So that is definitely a example of a money laundering risk. So if you identify a client where they have a bank account and they don't use it quite a lot, but suddenly $1 million is coming in and $1 million is going out. $1 million comes in and $1 million goes out. And this type of account is not a business account. They don't use it for a day-to-day business. Something a red flag. Transactions routed through several jurisdictions. So we got money from Mauritius, but that person, we asked them from where did they get? They got it from Dubai. From where the Dubai person got, he got it from UK. Where the UK person got, he got it from US. So if it is routed through several jurisdictions, or one company is getting money from more than 5 to 6 countries around the globe, like what are they doing? They are one simple company in a country and they are getting money from lot of countries outside their jurisdiction country. That is money laundering. Secrecy over transactions. The client does not want to disclose. They're saying that, yeah, this is a normal business dealing. You don't interfere. All these are indicators of money launderers. So when we are answering the question in a scenario, look out for these instances. Look out for saying that maybe in scenario they might say, oh, you know what? This company used to get a lot of transactions, foreign currency transactions from a lot of foreign countries. So you can explain to the examiner that this is an indication of money laundering and there is a risk involved in terms of money laundering. That's how you need to respond. So take a note of this. This is very important, and money laundering is becoming a hot topic these days. And even in current issues, money laundering can be asked as a question. The reason is because bitcoins, cryptocurrencies are becoming a hot topic of the day, and a lot of financial frauds and money laundering cases that have recently developed identified in UK, Singapore. I'm sorry. Money laundering can be asked as a question in your exam. So do note of it. It's a very important part of